Let me start with one of the most common and most confusing questions almost every NRI has asked at some point. If I sell my mutual funds in India while I'm living abroad, do I need to pay taxes in India and then again in the country where I live in? It's a fair question, and to be honest, most answers that you find online are either too technical or incomplete. So in this video, I want to break it down in the simplest possible way. Let's say you are an NRI investing in Indian mutual funds. Now, when you sell your units, India will obviously tax you first. If it's an equity mutual fund, and you sell it within 1 year of purchasing, then you will pay short-term capital gain tax at 15%. On the other hand, if you sell it after a year, then it's long-term capital gain tax, which is currently taxed at 12.5% on any gains that you make over 1 lakh rupees in a given financial year. And these numbers are as per the latest Feb 2025 budget. But here is where it gets tricky. If you're living in a country that taxes global income like the UK, US, Canada or Australia, then you're also expected to declare the same gain in your local tax return abroad. Does that mean you get taxed twice? The answer is no. You are not taxed twice, but you may end up paying the higher of the two countries' tax rates. India has signed something called as Double Taxation Avoidance Agreement or DTAA with over 90 countries. What DTAA ensures is that the same income is not taxed in full twice. For example, India will tax you first, you then report that same gain in your tax return abroad and then claim credit for whatever you have paid in India. If your resident country's tax is higher, then you just pay the difference. So to wrap this up, no, you are not taxed twice, but depending on where you live, you may pay the higher of the two systems. DTAA helps, but only if you actually follow the process and file correctly.